So in this episode, we tackle one of the hottest finance and investment topics around, and we take the opportunity to discuss stocks versus property. If you've ever wondered what you should be thinking about before you decide to go into either or, this will be a great episode for you to check out. It's actually the very first time also as a four we decide to split up and tackle the topic as teams. So you hear that myself and ᴠɪᴇᴜs are going to be making a case for property, whilst Daniel and Olu are going to be making a case for investing in stocks. This is only going to be part one series of the discussion. Stay tuned for part two. Take off, take flight with you. We never fly away. Guys, welcome to episode 77, where today we invest time. All right, guys.
Wait, 1 second. Let me just check my crypto to make sure how happy I want to be today.
Yeah, check that.
By the way, just a very quick side note to our listeners. So, as everyone's aware, Daniel was one of the early investors in Bitcoin, one of the earliest. What you may not know is Daniel was also a very early investor in Dogecoin. So, if you see Daniel smiling with the fresh haircut and the new jumper, this is why.
All right, guys, checking in. Before we get started into this episode, just quick check-in terms of how everyone's doing. Quick pulse. How are we feeling? Daniel, let's start with Daniel because he's looking mighty fine today with a fresh trim. I haven't seen that in about a year with a turtleneck. Explain.
I'm feeling good, living better. Feeling good, living better. Simple.
Olu's wearing the same top as me, so he must be feeling good. What's going on?
I'm fantastic. How you doing? I can't complain. Life is good. Just moved into a new role. Started today, so I'm out of a project role, and I have a full-time role now. So I'm good. Life is good, and I'm excited for this episode.
Don't speak too soon.
I'm excited for this role. This conversation.
I wonder why. ᴠɪᴜᴜ, how you doing?
We are like what day of Ramadan? Is it day 9? So
day nine.
So yeah, a little bit dehydrated, a little bit tired, but this conversation is going to give me a lot of energy. So yeah, looking forward to this very exciting.
Likewise. I think we've all been looking forward to this episode. Maybe just to give the listeners a bit of before we actually go into exactly what it's about. We've been talking about this episode and preparing for it. Maybe how many weeks now? What, couple months? Would you say?
I think we've been waiting 2 years for this.
Some people have been preparing all their life for this conversation.
No. It's just what I do. It's what I live, right? So that's why maybe you might want to say it that way. But at least we've been talking about this episode for the last couple of weeks. So, guys, welcome to episode number 77. And today we want to invest some time to talk about a very hot trending topic in the finance world and investing world, which is basically property versus stocks. And so what we decided to do today is we've decided to actually create a format where we're splitting into teams. So we've always done a podcast based on us four working together. And today will be the very first time we'll be split up. So it will be Daniel and Olu will be basically making a case for stocks and investing in the stock market. And then myself and ᴠɪᴜᴜ will be making a case for investing in property. And what we're basically planning to do is we want to create this discussion to basically help someone who is working, right, a 9 to 5, who is saving, and they want to get started investing. They're not too sure whether they want to start in property or stocks. This discussion is going to help them to take a number of points that they can reflect on. So get ready, enjoy. Guys, gloves off. And what we're going to do is basically just do a nice round table. Each person's going to give a couple points, and then we're going to get into a discussion. So with that, the suspense is killing us. Right? Olu, why don't you, and also, like I said, bearing in mind, the idea is obviously to speak to the listeners, right? To give these points for the listeners, right? Because I think the other thing I also wanted to say is all of us in this group have a position in also stocks and also in property. So we're speaking from a standpoint of experience. We're going to bring that through. All we're basically doing, this is really points for you to reflect on if you're an early investor and wanting to get started. Don't take what we say, well, it depends on the points, right? But I'm just joking. No, so don't. So it's not financial advice. It's just a good discussion and debate. And it's really for you to reflect on. So we know you're going to basically get a lot from this.
Cool, perfect. Okay, so I thought I should get a little bit more comfortable. seeing that we're gonna be this is gonna be a bloodbath. You know, certain people are not ready. So I thought, let me get ready for this particular episode because
This guy,
the stock market has been good. The stock market has been good for some of us over here.
But let me just tell you, listen, that top hat is not going to help you, bro. Continue.
Alright,
Anyway,
cool.
let's go ahead.
I'm not
Let's go
sure.
ahead.
So
Let's go
for the listeners to be aware, what we will do now is each team will have the chance to give 3 points each, and then in between we'll also be interjecting and giving our take or challenge to those points. So Olu, you'll be kicking us off.
Thank you. And for the listeners, I also brought my calculator just to fact check some of the numbers that some of the property people will be stating and throwing out there so that we can just make sure we're as factual as possible. But let me take off this hat because it's quite difficult for my headphones.
I can imagine.
But let's get started. So my first point in regards to why I believe stocks is a better investment or asset than property starts with just the first one is low transactional fees, right? I think a lot of times when people purchase properties, they don't realize that they are customers, right? You're investing, you call yourself an owner, but you're also seen as a customer. And what I mean about that is you're a customer to the broker. You have to pay brokerage fee. You're a customer to your solicitor. You have to pay legal fees. You're a customer to the bank because you have to pay interest on your particular property. So before you can even purchase or even get into a game when it comes to purchasing a property, you're looking at a large amount of funds that you need to be able to even play the game. So you're going to hear a lot about no money down deals in later episodes or whatever. BS, right? At the end of the day, when you do a transaction, you have to pay certain fees to be able to purchase a property. Let's just do a high level assumption. So you're purchasing a property that's 100K, right? If it's an investment property, you need 20% deposit. That is 20K you need to play. On top of that, you're going to need stamp duty. If we talk about 3%, that's 3K. Then you're going to need broker fees, legal fees, which is like searches, all of these things that you need to do. That will come up to around 28 to 30K you need to buy a property that is worth 100K. Yes, you can leverage the rest of it, but that's 30K you're going to need to be able to play. Out of that 30K, around 8K of that is just fees. So it's you being a customer, you paying just to be able to play. When it comes to stocks, it's gone to a point now that you could do 0% commission-free investing. You got apps like Trading 212, Robinhood, M1, where you don't pay any commission to purchase ownership. And I want to be careful. We're not just talking about stocks, ownership of a business. Or you can even go into Vanguard where they will charge you 0.03% to be able to invest. So that's my first point, which I don't even think we need to talk or debate about that. It's facts. Stocks have a lower cost to play transactional fee.
I wasn't planning on debating. I just thought you took a long time to explain. It's just
I just wanted to make sure.
Yeah, the clock's ticking, bro. Clock's ticking. So
I wanted to make sure you understood.
It's clear. It's clear.
It's for our listeners. You know, it's for the
listeners.
Listeners.
Cool. Got it. Yeah, listeners, make a note of that one. All right, cool.
Second point I want to talk about is men lie, women lie, numbers don't. Yep. And what I mean about this is historically, the returns on the stock market surpasses the returns when it comes to purchasing properties. This is not an opinion. This is not, I don't think. This is facts. So if you were to invest in the property market, simple S&P 500, you don't have to start picking stocks, being creative, try to read up about this company, that company. You are guaranteed an annual return of 10% over the last 20, 30, 40 years. Everyone says if you want to know how the future is going to look like, you look at the past, history, right? So statistically, investing in the stock market provides a better return than property. Property, you're looking at 3 to 4%. Not bad, but not 10%. Just calling it how it is.
Yep.
That's my second point. I keep that. Is there any? Do we want to?
No, there's nothing.
Come on, bro. It's 3 points each. 3 points each. Have your time. Have your time.
And my third point is really around purchasing stock is ownership of great companies. Now, a lot of people think about stock market as don't really understand what is going on, or it feels like speculating and people are trading. Yes, there's that element of the stock market. But if you're doing the stock market similar to how you do property, you purchase good properties, you purchase good companies for a long period of time, then you're getting ownership of companies like Apple, Amazon. And when you think about that, is you now have these great CEOs, these great companies working for you. So whilst I'm sleeping, instead of me, as smart as I might think I am, building a property portfolio and all of that hard work that I need to do, when I'm investing in stocks, I get an opportunity to say, you know what, Elon Musk, you work for me. Jeff Bezos, previously in Amazon, you work for me. I can go to shareholder meetings. I can understand what they're doing in the company. And people say stocks are not tangible assets. I can't touch it. I can't see the bricks and waters. I can go to an Apple store and say, I own a percentage of this, right? I can look at a company like Coca-Cola. I own a percentage of this. And when Coca-Cola makes revenue at the end of the year, guess what they do? They pay me dividends. The same as you getting paid in a rent in terms of income, I also get paid in terms of a stock. But the only difference is I've got these great minds, these geniuses, these engineering development teams working to make me richer. So that's my final point.
Cool. Love.
Ollie, can I just say, I'm actually just glad that you're still breathing, because I thought you weren't breathing through all of that. That was coming straight from the chest, straight from the heart. Wow.
I'm not going to lie to you guys. It's getting a little hot, so I'm going to take off this.
Remember, you're speaking to someone that is love the passion, love the energy, and I guess you're kicking us off in the right direction. So that's good. So I'll mention 3 points, and then we can have a discussion in terms of debating. Some of those points actually are going to speak to your point. So I think before I kick off, I think it's very important that for any listener, when they're reflecting on points, is you have to set a number of objectives as to why you're actually investing in stock or in property, right? Why your goal in investing may actually contradict a lot of the things that Olu had said. So that's something that also to keep in mind. So for me, the very first thing as to why I would sort of argue and make a strong case for property is that property investors get into property because they're able to get paid 2 ways, right? One in the capital appreciation side, and they're also looking forward to the monthly income that comes in each month. So the passive monthly income is a very strong proposition as to why property is a strong case. But this is why I think it differs compared to stock, right? Because yes, in stock, you get the capital appreciation on the money you've invested, and yes, you do get a dividend. Now, most of the best stocks either pay on an annual basis, sometimes quarterly. Some of the best companies don't actually pay a dividend at all. But where I think the difference is that we have to understand that the cash flow, the way that the cash flow is tied to the asset itself. If a property was to decrease in value, you still be receiving the same rental income. If the value of your stock was to decrease, that would also affect the amount of dividend you actually receive. So the monthly income from a property makes it a very, very strong proposition. And if one of your goals is to build up an income to replace maybe your work, then that's something that one should actually consider. And so that's the first thing. On the second thing is, Olu brought this up with regards to being a tangible asset. Now, again, it depends on how you want to look at it, but I think you can't argue the fact that a property is something you can touch, feel, you can see it, right? It's there. And it's the idea, if this is what you're interested in as an investor, your money is in bricks, which will be there. And historically, look, we know buildings that have been there for hundreds of years. So when we talk about tangible assets, yes, Olu, you make a case, but I think you can't argue with the fact that it doesn't get any more tangible than property. That could be something which a property investor would be interested in. The third point that I actually want to make is around the element of control, right? So I believe that property, and at least that's the way I feel when I'm investing, I believe I have a lot more control on the properties that I invest in owning compared to the stocks that I may have. And what do I mean by that? I can actually control, let's say, the price of the asset. If I bring it up to a good quality in terms of refurb, I can control then what kind of tenants I want to bring into the property. I can also control the price points, also based on the level of refurb. So there's a much more hands-on and ability to manage the systems around the property versus a stock. Right, with a stock, I don't have control over the products that these companies are picking. I don't have control over the pipeline that they're building. Right, it's very much a invest, hope that the CEO will basically do well by what they have said. Right, so this is the thing. If you talk about control, maybe the way it depends on how you want to split it. But for me, I think there's a lot more control with property than there is with a stock. So those are my 3 points. As to why someone should consider investing in property versus stocks. So what we'll do is we'll pause it there, and if we want to have a sort of a debate on some of the points that have been mentioned.
Sure. No, I think you mentioned some great points. The first question, and I wanted to dig a little deeper into, is what you talked about as passive income. Yep. And I think a lot of people talk about passive income in terms of property, but it's smoke and mirrors.
Ooh,
and the reason why I talk about it as smoke and mirrors is you have to invest, and you didn't talk about it, but a large amount of transactional fees or upfront costs to be able to get that passive income.
It's a different discussion. Okay, good. Sorry, continue.
But it's passive. Yes, passive income is passive income.
Continue.
And then also on a life cycle of a property, it's marginal. And when I say it's marginal, so let me go back to the example that I mentioned before. You purchase a property for 100K. Let's assume that you're making £600 a month, right? Good ROI, thinking about somewhere up north, somewhere like Liverpool, right? Assuming you're getting a management team to manage that property, you're looking at 10% roughly, yeah? So £60 that goes there, right? Then you need to pay around £200 a month, interest only, right? So interest only, so you still need to pay back the principal amount.
But can you get to the point about passive though? Because you're talking about this is the business.
No, so this is the passive, right?
Okay.
So this is the element of the passive. So I'm showing that people see passive as one, the return, the rent that you get, but that's not really what you take home, right? After all the different fees that you have, from that £600, you're pretty much taking around 290, 300, right? Let me just finish.
Okay, yeah, go ahead.
And then with that, if you annualize that, you're looking at maybe 3.5K, right? That's not taking into consideration a boiler break-in, all the maintenance. And if we talk, and we've all lived through the experience, right? A tenant not paying, all of these things that happen based on owning a property, being an owner, you're going to find out at the end of your life cycle of that property, you're not making that much passive income. Like a lot of times when we talk about passive income and we talk about property generating wealth, it's not really the passive income. It is the appreciation of the asset. That's why when we all talk about, hey, we're looking for ideal investors, you're looking for these old people that purchased properties years ago, is now appreciated to a crazy amount of point. They might have particularly sold it or they don't have a loan on it. But the passive income is just the maintaining that asset versus you're truly balling out of it. And I think a lot of people say passive income, but not that many people are balling off the passive income from a property.
Okay, so a couple of things. So one, let's keep in the context of where we're speaking to someone that is working a 9 to 5, and they're thinking about what to start. So I would first say that it's more passive than your 9 to 5. That's number one. Number two, a lot of the points you mentioned is really just, you're talking about a business, right? You have your revenue, which is your gross, which is your rent. Then you've got a number of expenses before you've then got your net income, right? So the point around having to pay your management fee, which I personally believe you're actually hiring someone to manage your property, that speaks to the advantage, and a number of points. So, but if we talk about the passive income, right? Like I said, it's much more passive than a 9 to 5. And how else do I want to say that? I'm thinking about your point around the boiler. I think your points are more speaking to the return on investment, right? But in my experience, what I have found, I have detached my time from being able to generate income in a property. So I think it's very important that we make sure we talk about the passive element versus the actual return on investment. The return on investment is another discussion. If a boiler breaks, that comes into it. But is it passive? Is it more passive than a 9 to 5? 100%. Right.
Agreed.
Now,
would you say it's more passive than stocks? So
no, it's not. So this is where now people want to consider the difference. So stocks is something where you really, your time is completely detached. It's a couple clicks and then your money's invested. But this is where the difference is. If you are focused on monthly passive income, then property is something you want to consider. A lot of the best stocks sometimes don't even pay a dividend. They pay an annual dividend, right? And there are very few companies that people advise that are actually paying on a monthly basis, right? So most property. So that's my points, and then we can share.
But then coming back to that, and when we're thinking about rent, say monthly income or dividends, if you're investing, you're looking more of the longer term. Investment isn't. You're thinking of stock as an investment vehicle. So over time, there's going to be compound of interest. You're going to generate X amount, providing that you have a good strategy and the stocks that you've invested in are doing well. Of course, with external factors, market conditions, economic factors, political factors, of course, can all play a part in how well those stocks perform. Similarly, can they do the same in the housing market? But when you look at the longer term trajectory, me personally, I see a stock that pays dividends is like buying a car because it's got a nice speaker. I wouldn't personally buy a stock because pays a dividend, because ultimately all I want in that dividend is to reinvest into the company for more shares. So when I think about
Daniel,
that,
I would say that same logic would also be the same logic as property, right? If you're making,
I disagree.
The reason why I say, let me just, the reason why
I think you should let Daniel finish his point, because Ollie, you already mentioned your piece.
Yeah, go on.
Yeah.
I lost my train of thought, but I was going on to the point now.
No, you reinvest in your dividends. You're saying reinvest
so that it will continue to compound. And I forgot the actual ultimate point I was making. But anyway, sorry.
Was it around that? Was it because had the discussion was around the whole passive element, right, Daniel?
Yeah, I've lost it completely.
But so what I'm saying is, and that's in my mind, that's the same as property, right? Because if you buy one property, you'd be a fool not to use that passive income to try and either pay down your loan or purchase more properties, because one property is not going to make you financially free.
Yeah, but probably one stock won't do that either.
And that's why you do the compounding. The logic of
but
it
then
is
you get,
just the
but
same.
then you'll also get. So I think my take just on this, because I don't want us to hang on this too much. The passive element, I think this can also be a mixed experience, right? You could argue that someone who's invested all their money in stocks, they may not be able to handle the emotional roller coaster around the volatility, for example, right? So there's pros and cons with all of these different asset classes. I think it depends on you as a person. If I think for me, myself, on personal experience, I am investing in an area where I have family who are basically involved with the business day to day. So they're involved with the process. That also, if I think about the hours that I've spent over the last 2 years working on this versus anything else, for me, it's actually been, there's a massive difference in terms of the amount of time and energy I've spent on this versus anything else. So for me personally, it has been very passive. There are, of course, moments where the boiler has broken down or a tenant hasn't been paying rent. But I would say by and large, 95% of the time, it has been extremely passive. Once you've got past those initial startup costs, which, as Vivilo said, the way that I see it is a business operating expense to get your foot in the door. Ollie, you made a great point about the fact that shares, you don't have that barrier at the beginning. Yes, that's true. But again, I think going back to what Vivilo was saying, it really depends on what you're looking for. If you are trying to prioritize monthly cash flow, and you're trying to get that cash flow up to the level where you can quit your job, then I personally think property is probably a faster way to do that if that's your goal. If you have another goal, then maybe stocks is another option. But that's just the take on the passive piece.
I hear what you guys are saying. I still stand with my point. I think people, based on people seeing the money coming in, they think that they're really making a return. But passive income, you've got to also look at what your expenses are. You can't just look at passive income as, hey, I'm getting £600 a month. If you're getting £600 a month,
nobody looks at it.
But then I think that goes to Ollie's. So just one quick comment. I think this also goes to a bit to, because then there's two different topics, right? Passive, or maybe we should align on what the definition of passive is. For me, passive income is the definition of generating income which is completely detached with my level of output that's required. So I'm not having, so with regards to like the other things, surprises that come up, that I think is just the cost of business. And I think that you can talk about the return maybe on property being slightly different versus stocks. But I think for me, the definition of passive.
So you're talking about the time you need to spend into.
That's at least that's in my mind to make sure.
And if you're talking, that's how you define passive. That's how you define passive.
So no, I'm talking about, because the passive income, right? I see as two things. Is one, the time that you spend, which I totally agree with you guys. But if you're spending 0 time and your income is 0 because of the expense, is 0 passive income in terms of the actual dollar amount. Yeah. So in terms of the time that you guys mentioned, right? I don't believe that is passive. Like, the reason why it's not passive is because you spend time finding a property. Even if you're outsourcing or whatever like that, let's be honest, we've been on Rightmove for time. We've gone to multiple viewings.
All right.
Even when we talk about passive, even when we talk about passive, just in terms of, I've got a property manager. A property manager is an admin. Let's be honest. All they're doing is collecting phone calls, calling you, telling you, hey, and they basically arranging and whatever. But it's not like I just, like stocks, I don't need to think about it and I'm seeing money coming into my account. There's still time that you need to spend on the property.
So a couple of things. So one, remember, keep in mind, we're talking about someone in a position of a 9 to 5, what avenue they want to go in, right? So it is much more passive than that position. I think you're being a bit slick by confusing the points at which you invest. There's always going to be work up front, and we're not denying that, right? But we're talking about
a lot of work.
People get into, well, it depends how many years of experience you've been into. Anyways, but let's say you're starting. Let's say you're starting. People get into property because they understand that every month they're going to receive an income, right? After expenses, after fees, right? Now, if you put the right systems around it and you've got the right education, that is going to be very passive. When we get into personal examples in part 2, part 3, I can share, over the last 5 years, it's been very passive. If I compare, I have to work, I don't know, whatever, 50, 60 hours for my 9 to 5. I probably work maybe an hour, maybe less than that on the portfolio that I have today, right? So for me,
agree with everything you're saying, P. Everything you're saying is right.
That for me, I think is passive. In terms of if you're making money each month, right? That comes down to return on investment, which we come on to.
And P, everything that you're saying, I totally agree. Totally agree. I'm just saying, the conversation is stocks versus properties, not property versus 9 to 5. Because everything you've said, I 110% agree with.
But then
I'm just saying,
so if you want to just plug into that one, go back to the thing that people want to keep in mind is the monthly income versus annual dividends or quarterly. So that's what you want to keep in mind.
Okay.
But let's shift over to Daniel and then Shuol.
Okay, great. Thank you. So my first point in terms of favoring stocks over property is, firstly, what do we value the most? What do we value most in life?
What are you asking?
I'm asking.
You're asking.
I actually value Daniel's turtleneck for anyone that's not having the luxury to watch.
So the first thing is time, transactional time. How long does it take you to buy a property? When it comes to all the research, finding a location, demographic, the viewings, making offers, solicitors, surveyors, all of that process. Yes, you can have a good structure in place once you've kick the first one out the park. And you can have a well-oiled machine. But apart from that, there is a lot of time taken to do in terms of purchasing a property. With stocks, I'm not saying it's like one click and you buy. That's if you're impulsive, you're emotionally led. But of course, you do your research. You can do some fundamentals, some technical analysis, and you can be tracking some of these stocks. But the time that it takes is a lot less than buying property. Second, diversification. It's very easy to diversify when you're buying stocks. You can look at growth industries, so cannabis-related companies. You can look at technology, which is doing well, especially in Southeast Asia. You can couple a lot of these, not metrics, a lot of these kind of industries with growth and different parts of how they operate, and combine them to find a very good stock and invest in that. Of course, you can look at retail. You can look at the more traditional and the longer-term growth ones, like say Apple. Amazon. Of course, you can diversify your portfolio. I don't know how well we can do that with property, but with stocks, it's very easy to do so. The last one is liquidity. Have Shuol or P, have either of you sold a property or in the process of selling a property?
No, you continue. You're absolutely right. Continue.
No, I'm asking question. Have either of you sold?
I'm actually in the process of selling one.
No, how long And how long have you been trying to sell a property?
That one that I just had the sale agreed has been on the market since beginning of March.
Beginning of March. So what? About 6 weeks.
So it's about
So
it could be
6 weeks.
months.
And yeah, it could be 6 weeks. It could be 6 months. It could be 2 days.
Yep.
Well, not 2 days, but it can be very short. It can be very long, depending on finding a buyer. If there's a chain, mortgage offers. Any breakdown in any step can be hugely detrimental to the selling of a property. When it comes to stocks, there's tends to be a lot of liquidity in the market. So even if I want to buy, there are many people out there selling for different prices. Think of it like an eBay market. Once the best offer's gone, you go down, and that's why the price that you may buy a stock for may not be the price that you saw advertised, because in that time the stock's been bought. The same way when you want to sell, there are many buyers out there who want to buy the stock. So in terms of liquidity, it's very quick to turn the ownership of a stock, ownership of a company, into liquid cash. Usually it will transact and settle within T+3 days. So in 3 days, 3 working days, I can have that cash in my bank account. And just trying to go on to Olu's point before, and I know ownership's been a key point. When you look at stocks, you got to look at it from a different perspective. The company, are pitching to us their idea, their company, their ethos, their ethics, for me to want to invest in them, because they need my money. When a company is listed on the stock market, they need my money to raise finance, whether it's to pay off debts, whether it's to expand, whether it's to diversify, whatever it may be, they need my money. Think of it like Dragon's Den. When they come up, they pitch the Dragons, Deborah Mead, Peter Jones, all of them, about their idea for a stake in the business, in the company. So when you think about buying a stock, we are the Dragons. And when you know what you're doing, how often do the Dragons invest in the companies? Very little. So you got to find that niche, that one that's going to do well, that you believe in, that is going to generate revenue. So that's why when it comes to, even people say, oh, you can pick a bad stock. Yeah, you can. But if you know what you're doing, you can do something and compound it multiple times. So those are my 3 points.
Okay, perfect.
Great.
Thanks, Daniel, for the points. So then I'll give my 3 points as to why we are team property, and then we'll open up again for a good discussion with the team. So 3 points that I have. The first one is focusing around the volatility. So I think the angle that Olu and Daniel have spoken about, they've spoken about stocks, especially during the period, the last 10 years, where we've probably seen the most growth that we've probably ever done. But then we know that there's cycles with this. Now, of course, there's cycles in property. But I think historically, if you look at the market, there's probably been less volatility in the property market versus the stock market. Now, overall, we would argue that there are less market shocks. Now, of course, there are changes, but I would also argue that we also don't necessarily have to monitor the price of our assets as much as people with stocks. Now, you could argue that once you invest in a stock, we don't actually spend that much time looking at it. But I personally, if I think about my friends that have invested in stocks, they're probably looking at it quite regularly. It's anecdotal, it's not data backed. But if I think about the circle that I have, the people that have invested are spending their time. So Daniel, I know you mentioned time as a strength for stocks, but you're spending time looking at the price changes, and you're probably a bit more wary of those variables. I think the other point around the volatility that I would also mention is that real estate prices, they're driven predominantly by demand in that particular area, and maybe how the economy of that country is doing, which of course you could argue is linked to the global economy. Now with stocks personally, I think are linked to multiple variables, probably even more variables globally. So going back to the point that ᴠɪᴇᴡs mentioned about control, here you're not just investing in a company, but you're investing in a company that's probably heavily linked with multiple global macroeconomic variables. Now, of course, the property market is to a certain extent linked to that, but I think it's a bit more insular to variables that you can control, that variables that you're probably closer to, that you understand a bit more, if you're just thinking about maybe a local area or an area that you want to build expertise in the UK property market. So that's the one around less volatility. The other point I want to raise, the second point, is around tax advantages. So I think we're talking about investing in property, not to buy your first home, but investing as a business. Now, with any business, once you've got a good accountant to set up, so again, we're not financial advisors in this call, please ensure they talk to a good solicitor, a good accountant, etc. once you have a business set up, then you have the power and you have the benefit to treat that investment like a business. So this means with real estate, once you have the property company set up, you have depreciation, the operating expenses that Olu has also mentioned as well. This can come down and reduce your profit levels, where you can basically put this all together where you can give yourself a tax advantage from investing in property. I don't know if whether you invest in stock, apart from maybe ISAs, if you invest in stocks generally, there are, of course, taxes you need to pay, capital gains tax, etc. And that's, if you don't put it in an ISA, there's probably even more taxes and stuff that you need to manage. So this is something that I would just want people to be conscious of. With a property investment, you have these tax advantages and you can treat it like a business. The same way that Olu expects Apple to treat their cash flow and taxes as a company, we can actually do that with our property investments. And then the last point that I would make before we open up for the discussion again is the ability to leverage and borrowing against this asset. Now, if I give an example here for the listeners, if I went to HSBC and I asked HSBC to lend me £30,000, and I said, okay, HSBC, can you lend me £30,000? And with this money, I want to buy £30,000 of HSBC stock. What would HSBC say to me?
They're likely to say
no.
I think
yeah, they'll probably say no. Yeah.
If I went to them and I said, okay, and Ollie, just using your example, HSBC, I have £30,000 I want to pay, and I want to invest this in an asset that's worth 100k, or probably worth 100k. What would HSBC likely say to me for that?
What interest rate do you want? Sign here.
First, they will fact check all the information you give them, and then they will give you the loan. Then
so the point I'm just trying to make there is the fact that with 30k, yes, there is leverage. Yes, you have to pay the principal back. Olu, you made all these points earlier. But the point that I'm trying to make is you still have leverage, that there's a larger pot to play with. And if the person that's lending you the money sees the real estate as a more safer investment, they are lending the money to me. If they see that as a safer investment than stock investments, and these are banks that have been around for hundreds of years, they know their business model, then I think that also speaks to not just the leverage, but going back to the previous points about the volatility and the reliability of this particular investment class. So those are my 3 points: less volatility, the tax advantages, and then the ability to leverage and borrow.
Strong.
I think you had some great points. Great points.
Great points to the list.
Great points.
Just a couple of things. I think, just coming back to Daniel's point around the time, right? And I think, again, it comes back to how you're thinking as an investor. I think it's safe to say that we're all thinking long term. So one of the ways to look at it is that, would you invest 3 months, 4 months upfront today to have an asset over a 30-year period? I would. So it's putting the short-term investment of finding the right area, right property into its proper context. I'm not holding the property for a year or two. I'm planning to hold it for 30 years and even pass it down to the children. So I think yes, there is time, perhaps more time, but in what context? So that's something to consider. I think I just wanted to actually double down a little bit on Shua's point around leverage, and then I can pass it on to you guys, because another way I think people to look at leverage is, you may argue that you can also leverage within stock as well, but the way to look at it, Shua gave an example: a standard property worth 100,000, you would need, say, around 30,000 to invest, and then the bank will basically then loan you the remaining amount. You can expect that property to give you at least £300 a month, right? So 3,600 a year. I would like to understand what stock you could basically, how much would you need to invest in some of the best stocks to make £300 a month, right? And the difference in that amount, I think, speaks to the leverage. So just something for you guys to maybe speak on.
First question, I'll ask you, that 3,600 that you're talking about, is that return on investment or is it income?
That's net. No, net. After
it won't be
minus
net. Because and that's my whole point about property, right? In terms of the smoke and mirrors, the reason it's not net is because there's expenses that come up over the life of owning a property that you have to pay. You have to pay that. That needs to be paid. So we all like to say like the best case scenario, and we live like, if day one you're not going to find a tenant in your property, right? There's all these different things that's going to mean over the lifetime of your property, you're not getting that 3,600 that you're talking about on an annual basis. But In regards to
so just okay, that's because you're making a case as to why property doesn't work, and that's fine. I see the point. We can also look at stocks that don't work, right?
Yeah.
And how they basically lose value over time. You don't have any dividends, so we can also go there as well. But I think the point I want you to look into is to understand. Just taking that case study, right? Assuming that it works, assuming that we say you're making £300 a month net,
yeah,
and that came from a £30,000 investment. How much would you need to invest into the stock market or into a stock or to a company stock to earn £300 a month?
So if I wanted to earn £300 a month, I'm looking at approximately around 50 to 60k, 50 to 60k in dividends that provides me around 4 to 5% dividend stocks.
Are you sure?
Yeah. So you could. I've got my calculator here. So
you sure it's not a lot more than that, big man?
So you could do it. You could do the calculation.
But
6k doing a 5% thing. Gets you 3k annually. And when I'm talking about the annual,
and then the point I'll say to you is that 5% guaranteed every single year? No, right?
So,
it's the same thing. It's the same thing with the property.
But with stocks, you can diversify. So you have your own base. You can create your own index, your own portfolio, where there are going to be ones that are going to grow higher.
But the difference with that is,
but you need to know that. But there will also, you've got trends. You've got trends. You've got what's the obvious trend. So last year in the pandemic, you had working from home. We had homeschooling. We had Zoom calls. We had even veganism on the rise. You can invest into stocks that support them. So Zoom, that went up 60% in 3 months. There were many stocks that ballooned last year. In March, they all went on sale. And if you bought then, by June, you're 3 times your money. There are also the not so obvious trends. So things that you find on ground level through conversations. So you can be going to a dentist. Dentist says, oh, Invisalign has been popping off. A lot of people have been buying Invisalign in the last couple of months, last couple of years. Okay, great. You go and do some research. Who creates these braces? Look at companies, find them, invest in them. These are the ones that take longer to hit the ears of people that are going to invest. In finance and the stock market, news travels slow. So anything that happens on the ground, your company starting to invest in Lenovo, Toshiba laptops, Windows or Surface laptops, whatever they may be, oh great. How many offices do we have? Are they doing it company-wide? Why not me? Why should I not invest in Microsoft or Lenovo? One of them. There are these things that will help you grow. Of course, there could be volatility over the month, but longer term over the year, you can create very good returns in a percentage. 10% has been generous. If you know what you're doing, you can make it even higher. And I want to come into the point. Sorry, before Shuel, volatility. You mentioned volatility. You said a lot of your friends monitor their pricing or their portfolio regularly. My question is to them is, what is their strategy? Why are they checking regularly? If that was to 10 times in a day, would they sell it? Or would they just be like, oh, great, my portfolio's up? Because the same way you're looking at your portfolio, what benefit does it bring? Do you look at the property value every week? No. If you know what you're doing, you let it sit there, you let it grow, you let it appreciate over time. I liken my portfolio to a property. I don't check the property value. I don't check my portfolio regularly.
But I think, Daniel,
that's good to know. But
it's all got to do with mindset, right? And I think what you mentioned in terms of volatility, right, is a great point. And I want to talk to the listeners in this. Because it feeds to people's mindset, right? If you're someone that's very emotional, right, the volatility will force you to sell. We've seen it with cryptocurrency. We've seen it with it drops, goes back up, etc. Right? But what is factual in the fact is, forget about the volatility. If we look at the annualized return, because volatility is cool. Yes, it goes up and down, right? In 1 year, it could go down 10%. The next year, it can go up 20%. Annualized, you're looking at around 10% each. The annualized increase over 10, 20, 30, 40, 50 years has shown that stocks, S&P 500, has a vastly better return than property.
So if I can go next, so just to very quickly on that point, Olu, I think that's great if you're looking to retire in 50 or 40 years time. But if you're looking to get out of your job quicker and you want that monthly cash flow, then I think that's probably not the strategy that you want to take. And again, this depends on the listener. It starts with the why. right? If you're trying to get a general monthly cash flow figure and you want to scale,
exactly.
But just to quickly come back to Daniel's one, sorry. So, because Daniel, you mentioned about the diversity, right? And then all these other industries and all of these things. But what I heard when you were explaining all of that is that actually takes time, right? You need to take time to understand what you're doing. You need to take time to understand what all these acronyms are. You need time to understand what these industries are. You mentioned about how information flows slowly through the financial markets, but then you need to take time to understand it, especially if you said that it's going slow. So all of this actually takes time. So you were saying property doesn't work because there's a lot of there's a lot of things, but then there's also that time element to it. And then I think also about the trends, there are global trends, and I think that's a fair point. And there's lots of growing industries, right? We've seen the ones that you've just mentioned, Zoom, online meetings, all of this stuff has gone up. But then I think with property, it's even more simpler because we also see trends as well. We see a growing population across the UK. We also see that the amount of land where we are investing isn't increasing. In the city that I invest in, the number of people privately owning their homes has gone from 40% in 1991 to around 20% today. So we are actually in a position where we see trends and we can actually take a direct impact and control to that as well. So I think
Yeah, so I totally agree with everything you're saying there. In regards to what Daniel was talking about, those sort of investment, Daniel's talking about more complex sort of investing. If you're going in terms of S&P 500, the level of time, and that's what I'm trying to keep this really quite simple with. Just invest in the index S&P 500, zero amount of trying to understand, because S&P 500 for the listeners is made up of multiple companies, 500 of the top companies, right? So in those situations, I don't need to be checking the industry, what's going on in Asia, blah, 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 etc. I don't need to do all of that. That takes zero time. I don't need to be looking at my phone every so often. The volatility is lower. The return based on history, you're looking at 10%. In regards of what you talk about tax, right? Because another point you mentioned was about tax. In terms of when you guys sell a property, you have to pay capital gain tax, right? On selling the property.
It wasn't talking about selling though.
No, agreed. So in terms of stocks, right? Stocks, if I sell stocks, I have to pay capital gain. Same as if you guys were to sell a property, you have to pay capital gain. Same. Now, in terms of the dividends, if you're getting dividends, you get 2K allowance on dividends. Firstly,
what about the value of the stock?
I don't pay any taxes if it's going up. It's like it's just like a property. If it's appreciating, I don't pay taxes until I sell it.
But that's the thing. You get.
Do you not submit the value of your stock to the taxman?
No, it's just you don't need to. Only if you're selling it.
It's only if it's selling and if it's over the threshold. So your personal allowance without it being an ISA is about 12,500.
And when it goes above the threshold,
you get 20,000. You get 20,000.
No, that's input. So you put in 20K. But in terms of if that 20K goes up to 100K, I don't need to report that to anyone in terms of pay taxes.
It's unless only when you sell it.
Only when you're selling.
So only when you sell it, you pay the tax. If it's in your ISA, it's gone from 20 to 200. You don't pay any tax.
2 million, whatever number. I don't pay any tax.
Don't you declare the value of your ISA? That's my point.
No,
you don't need to. No,
you don't. You need to declare it until you've sold.
No, what you're thinking about is that.
No, but isn't the ISA a cash account? What do you not show?
No, so this is the way it works. So the ISA, you get a stock ISA, and the way it works is you get a maximum amount of money you can put into the ISA. So I could put a maximum of 20K in a tax year. Now that 20K that I put in, I don't need to declare it anywhere. It's 20K is the max, right? Now, if that 20K goes to 2 million or whatever number, I don't need to now tell someone that 20K is now gone to 2 million. That's fine. Until I sell it, then I need to say, but because it's in an ISA, you don't even need to pay any taxes on on a profit. So I won't even have to pay anything on that. Same with dividends, so I think one myth is with stocks, again, you don't sell it, you don't pay any taxes until you sell it. That is
but then just on that tax point, were you going to carry on talking about that? I
was going to continue on that point.
Okay, good.
So then in regards to dividends, so that's the way where you're getting paid. Now, what is the tax that you pay on the dividends? Just like what would be the tax, what you pay on your rental income? Like
it depends how you offset with expenses though.
Agreed. So the benefit that you get with properties, you can offset it with expenses. But if we're doing it the right way, right, which we're trying to preach is those expenses have to be related to the property, right? Is
That is the right way.
No, I'm just saying because exactly that's what we're preaching. We're preaching the legal way. Yeah. So
no one's trying to open up some Jordan Belfort case over here.
So with dividends, what you have there in terms of taxes, you have a 2K allowance. So just like your personal allowance, so you don't pay anything unless it's over 2K. And then when you pay it, you got like 7% that you have to pay tax on, like basic rate, and then 30% on like based on like 20 to 50K and whatever. So in terms of tax benefits, it's not so far away from property. The only difference is you guys get to write off any expenses associated to the property. But owning dividends and getting stocks, you don't have any expenses. I don't have any maintenance or whatever expenses to get in that particular stock.
Just quickly, I wanted to ask Ollie a question because Ollie, you're making a strong case for obviously the returns on stock over a long period of time, and I see that. If a listener's listening now and they're thinking about freedom, how do I get to freedom? Which vehicle would you say could provide them with the financial freedom sooner?
Crypto.
No, wait, no.
I'll be honest with you. So, and I was pondering this all throughout our conversation, right? And I knew this question was going to come up, so I knew this was going to be your big point. And even
it's not a big point. It's just a question. It's not a big point. Yeah, I'm just saying. Not a big
even
point.
Shawal mentioned that, right, in terms of property gaining freedom, but property doesn't really gain freedom unless what gains freedom is businesses. That is, if I'm honest with you, is owning and buying businesses. Because but that's not the discussion though. The discussion is between, as you mentioned earlier to me, exactly. So I think in both cases, in my sense, in both cases, they both would take the same amount of time. In terms of all the people that I've seen make crazy amount of money from property and truly be financially free.
Yeah.
Are people that are not doing investment in individual companies. And let's not light it like owning 2, 3, 4, 5 properties to our listeners, right? It's not really going to make them financially free until they've paid off that debt or they've like it's true, guys. Let's be honest. How many if we go around here and say how many properties we each own, right? I have ownership of 3 properties, right? Back in the day, I don't want a listener to think by having ownership of 3 properties, you're going to be financially free. Because that's not the case.
With that, just
hang on one second, because I think it's important not to be slick and just answer the question as it is, right? In the sense of, is your answer to the question both will take the same amount of time to get to financial freedom? That's what you're saying. This guy, man.
I would say.
Are you saying yes to that? Are you saying it would take the same amount of time to reach freedom with property and also in stocks? In terms of the dividends,
how much debt you've leveraged?
There's so many elements, like the debt and everything.
Let me ask you.
Give me a scenario. Give me a scenario.
Can I make a very quick one very quick observation though? Yeah. The way that the narrative sounds though, Olu, is you're comparing investing in multiple baskets of stocks versus investing in one property.
No, even 2 properties.
That's the way, but I don't think. Yeah. But no, 2 properties won't make you financially free. People and I have never said 2 properties.
Okay. I've got. Sorry, I've just for this. I've got.
Just quickly, Daniel.
This is practical. Let Daniel. Let P go. Let P go.
This is practical. We all have pensions. We all have pensions. And when you're younger, what do they invest most in? How's it heavily weighted to? It's heavily weighted to equities because why? It's going to give you a greater and quicker return.
Okay, what's the point?
You're asking which one's going to make you more financially free.
I wouldn't argue that. It's not.
So when you think of pensions
are designed to pay out at 65.
Yeah.
Yes. So over time, it's trying to get you the most amount of money. So why would they heavily weight it towards equity rather than property and commodities?
Okay, that's what
I'm trying to say. I'm trying to use it to answer your question is. It's heavily weighted towards equities when you start investing your pension from a younger age because that's going to yield a greater return.
Answer your question this way, yeah? If you told me today I have a choice of only investing in stocks or only investing in properties, which one will I do? Yeah, I would go with stocks.
Okay, let me ask you another question. What vehicles
But
are you?
that wasn't Pabilo's question, by
Yeah,
the way.
it wasn't my question.
What? No, in terms of, because that's to get to financial. That would answer the question about getting to financial freedom quicker. If I looked at how much I put in my first property, first property, if I put that in the stock market, based on the returns that I'm getting right now, I would have vastly more equity and net worth than if I did with that I'm getting from that property.
Okay, so a couple of things. I think a couple of things. I think you should follow that advice and moving forward, focus only on stocks and see how that journey goes.
I will diversify. You have options. It's not 1 or 0. It's not one sum 0.
It's not one vehicle. No,
you're making a very, very passionate point, and I just think you should follow through that point. That's the first thing. The second thing is, what vehicle are you actually investing in today to achieve freedom? How are you building out your business?
I told you we're not having that conversation. It's business ownership.
Crypto.
But business in what space?
Business, and that's the perfect question, because what you're going to say, property is the best vehicle for starting a business. I'm not lying up like I'm trying to.
But it is business. Everything we're talking about is property.
So it's different, because there's a difference between. It's like Uber, for example, is in a transportation business. They don't own vehicles. There's a difference between doing a business in a particular space than actually investing and buying properties. It's complete. The game, we all know, that the game is cash flow. Let's be honest. The game is cash flow. The game is cash flow. How much cash flow can you get with no expense there? And in my mind, the best way to do that is through ownership of a business. Is my personal opinion. But we can agree to disagree.
100%. And I think, and that's why, look, so this is a topic which I think is very meaningful for our listeners. I think we've just got started today. Which is why we've decided to sort of create a part 2. There could be a part 3, depending on how the part right. But I think it's worth to flush out these points because this discussion has made me realize that actually we've really got some difference of opinions that I think that's very interesting. I'm quite surprised at some of the answers from some individuals, not all.
Not some, me.
Exactly. So anyways, but this is so we hope that actually we gave a number of points that will help you to reflect on if you are thinking about going with property versus stocks, what to think about. And you have to also look at the most important thing, and I think it's been mentioned in this conversation, you have to look at yourself as an investor and think about your appetite and what your objective is and which one can best serve your objective. And then with regards to part 2, what we're looking to do is actually get deeper into it. So we want to talk a little bit more on advanced strategies. So strengthening our case as to why property makes sense and why these guys think stocks make sense. And then we're also going to marry that to providing personal case studies. So we're actually going to share with you our numbers to support perhaps our argument or arguments, right? So stay tuned for part 2 and we'll bring that to you.
Great. So thank you. We hope you've enjoyed it. We hope it's been insightful. Please comment on our post. Let us know what you think, what's the winner, how you allocate to your kind of preference, whether it's stocks, property, or both. Of course, we've already focused on 2 investment vehicles for the sake of this conversation, and there are many more. But feel free to DM us at TakeFlight Podcast on Instagram or email us at takeflightpodcast@gmail.com. Wherever you are in the world, wherever you're listening, we hope you're well. Stay safe. God bless.
Take off, take